So I want to make a video about why you want to trade options and you don't want to do anything else, pretty much. So the problem with other things out there is that they are directional in nature. So if I bought Japanese stocks in 1989, I would be losing money for the past like 30 years. Okay. If I bought Japanese real estate, I'd be losing money for the past 30 years. And that's one deflationary problem. The next problem is inflationary. What if instead of that I get the opposite? I get a Venezuelan type effect. I have ridiculous inflation. Okay? That's another possibility. We don't know the future. So that's where options really come into play. And let's see. So you have those two things. You have either too much of an up move or too much of a downside move. And a great example of how options basically price that in is right here, the gold versus implied volatility. So when gold was spiking up, you saw a spike in the implied volatility. We were pricing in an even further up move, okay, in the options market. Then as gold was crashing, another spike in volatility. So it was pricing in the ups and the downs. And you really see that as well in the study here by Nomura. You can probably Google it. I'll post the link if I can. But so they go into all these indexes and sort of come up with a very very estimated sort of study. So like this is S&P, what the returns look like there. But in particular, we want to look at is markets that have gone sideways. So take emerging markets. They've just gone sideways. But what has the premium seller done? Made returns. What, let's see, Nikkei. Nikkei has gone sideways to up. What has the premium seller done? One. Euro stocks, unchanged. What has the premium seller done? One. Okay? It gets priced in. And that's something that no other asset has. If you're buying real estate, you need it to go up, or if you're buying stocks, you need it to go up. And yeah, you're gonna take some hits. In 1987, you would take a hit, but it's part of the game. But you're gonna be much better off with those hits every now and then than a total wipeout. Like here, you'd be wiped out. You wouldn't be able to get back in the game. Here, if you weren't in some sort of investment, you'd probably be wiped out. So that's the key points here, that you are market non-directional. You can Google it. What is a straddle? It is a beta neutral strategy. That's the most important point.